I'd like now to introduce what I think is one of the most fascinating areas of advanced valuation, certainly the more mathematical side, and that is the valuation of partial interests. Partial interests are where more than one party have some kind of a financial or investment interest in the one block of land, in the one piece of land. This introductory video is simply going to look primarily at the concepts involved in partial interest. The purpose here is not so much to go into the complex mathematical modelling, we'll leave that for a subsequent video, but rather just to show as simply as we can the way that partial interests can arise, why they're important, and introduce the way that they're calculated. So let's have a look at the theory of partial interest.
Partial interest is a fancy term that is given to a very simple, basic underlying mechanics. It is all based on the fact that often one piece of property has its value distributed amongst more than one person, especially when value is understood primarily in terms of rental. Partial interest is evaluated using discounted cash flow methods these days just about exclusively, although there are other methods that you may find in some of the older textbooks. It comes from the assumption that the value of a property is equal to the present value of the future rents, and so that already, as we've seen, gives you a discounted cash flow type of definition of property value, and we're going to assume highest and best use, and therefore partial interests are always worked out in some way with respect to market rent. That's the true market rent. The circumstances that you find partial interest operating in are really many and varied. Some of the most common ones are cases, for instance, where a lease sets the rental at a level below, and in fact in some cases above, the market level. And that means that rather than the owner taking the rental income, the full rental income, and being able to capitalise that into the value of the property, they're either taking less or more. As I say, most of the time it's less. And often it's a result of rental determinations not being frequent enough to respond to changes in the market. Other cases are where political pressure causes a leasehold interest to really start to have a permanent interest, valuable interest in what is in fact only a leasehold interest. And you find that especially with pastoral leaseholds. So pastoral interests are something that you can apply with considerable usefulness to things like much of Queensland's rural land, and for that matter all of the territory of the Australian Capital Territory, as well as other places. And so you find the politics behind ground rents and leasehold tenure is evaluated using partial interest. Another common reason why you have partial interest, you need to evaluate them, is amongst the various strategies that have evolved over the last 20 years mainly, although in fact they were operating for a lot longer than that, where effectively the ownership and the financial investment of the buildings on a land being split from the actual real estate, the underlying land. And in that case, usually what happens is that a landowner will award a ground lease, a land lease only, to an investor, either with or without a building, and the investor will then either inherit the building or construct some new development. The lease often runs for the economic life of the development or the building, the improvement, and so the investor is there owning the building and renting it out. Hopefully the property rent, that's the whole property rent, less the ground rent which is paid to the landowner, leaves the investor with enough return, enough annual rental to be able to provide a reasonable return on their investment, either in the building or the development. Another situation that gives rise to partial interest can be from easements and covenants, especially when easements affect the real utilisation, the highest and best use of the land in general. So you can use partial interest to value easements very often. and also as a result of other market imperfections. There are really an awful lot more situations where partial interests occur, and so it's good to have an eye out to be able to identify them, and that really is part of the trick, being able to see who is getting what share of the pie, the rental pie if you like, from the land. Let's look now at how you value them, and that begins by looking at how rent is supposedly awarded. Up to date, we've really been looking at situations where the market rent is what we're assuming the landowner is able to earn, but that often isn't the case. So in this situation, we'll say the market rent, we've got that line there showing the market rent at a particular level, but the actual rent, the face rent, the lease terms that have been agreed to, are actually somewhat less. This might be because there's some particular reason why the lessor doesn't feel it's appropriate to charge full market rent, or it could be because it's a very long lease and the rents haven't been reviewed to market in recent times or what have you. But for whatever reason, the rents are below the market. Oddly enough, if there's a major market downturn and the lease is set with a fixed rental, then the rent can be above the market rent. And so that creates a particular burden, if you like, for the tenant. Okay, so using our DCF, we can say, well, look at this over time, years 1, 2, 3, 4, up until the end of the lease. We can simply do the net present value of those rents, and that gives us the value of that part of the owner's interest which is tied up with the lease. When we get to the end of the lease, we assume that if the landlord has got himself tied up into a lease which is only returning less than market rent, then he'll be able to write a new lease which will bring the rents up to market, or maybe find a new tenant. Whatever happens, we usually assume that at the end of the lease, the remaining value, what we call the reversion, the land's interest, the value of the land, reverts back to the true owner. We assume that that's based on the market rent, and usually it's a capitalised market rent, so we use capitalisation to work out that reversionary interest. But the important thing about it is that the reversionary interest happens a long way into the future, 1, 2, 5, 10, 30 years into the future. And so while it might be worth $1 million or $10 million or something, the fact that you have to wait 10 years to get it means that that reversionary interest has to be discounted back to the present. When we look at it in this way, we can see that the lessor's total interest, which is made up of the lease term interest, the lessor's term interest, plus the lessor's reversionary interest, makes up the total value of the property in that circumstance to the landlord, the lessor. And we can do that using discounted cash flow methods, and that's what we're going to be working into. That's what we've done already in some cases. However, what about the gap between the market rent and the face rent, the rent that's being paid as part of the lease contract? Well, we put that in, and these are the green squares. What it means is that that gap, in this case, means that the lessee is getting a discount. So that's the same as actually being paid that much cash each year for the rest of the term of the lease. The lessee, therefore, has an interest, a valuable money equivalent financial interest, in staying on the property and seeing out the lease, because if they went anywhere else, they'd have to pay a lot more money. And so we can work out the lessee's interest by, again, using discounted cash flow methods to take the present value of each of the remaining years of the lease, that gap between the market rent and the actual terms of the rent coming out of the lease. In both cases, for the lessee and the lessor, which is the tenant and the landlord, the landowner, we use the same method, which is DCF, and we're able to basically apply a DCF for each interest, the lessee, the lessor. We have to be wary that there will be different risk situations for the two interests, and we'll go into that in more detail later. Okay, let's move on to looking at an example. going to look at a very simple example. I'm going to call it Uncle Bob's $1 million factory building. Let's imagine Uncle Bob has offered to give you his empty factory building because you want to start some business. You need a factory, you don't have any money. And he says, well, I'll give you the first year without any rent at all because I'm your uncle and I care for you and all that sort of stuff. So it's a $1 million property. So that means from Uncle Bob's point of view, in 12 months' time, if your business falls over, he's still got the $1 million property. However, from your point of view, you've just saved yourself the value of the rent. Now, we've got $1 million property. We're assuming a yield of 10% just to keep things nice and easy. We're not going to worry about growth. And we're going to use a discount rate of 10%. All nice and easy. What that means is that the rent that you would have been paid would have been a yield of 10% on $1 million is $100,000. And so you've saved yourself over the next 12 months $100,000. That's a really nice bonus from Uncle Bob. On the other hand, what's happened to Uncle Bob? Well, he's got the $1 million property. What's the cost to him? Well, it's really no cost in one sense because the factory is his and it continues to be his. However, now he has to wait for 12 months before he has access to it until he's able to earn rent from it or use it himself or sell it or what have you. And so having to wait for the 12 months means that we have to discount his interest, the $1 million, back to the present. We're going to assume a discount rate of 10%. That means that his $1 million property, 12 months' time, is only going to be worth $909,000 today. And so by the time you look at your interest as a tenant, you've got an interest to the value of $100,000. Uncle Bob's $1 million factory is still worth about the $1 million property, $1 million to him, except that he's really donated $100,000 of it to you, so he doesn't see that. And so his $1 million property is really only worth now about $900,000. Conceptually, the total of the various interests should very close to equal the total value of the property. The errors in this very, very simple example come purely because we've been a little bit loose in our definitions, and our $100,000 really should have been had a bit of discounting applied to it because of the rules of discounting and so on. I'll let you think through that. And so really, if the $100,000 was assumed to be saved in 12 months' time rather than today, it was really only worth $90,000 rather than $100,000. We're not going to worry too much about that at this point for this particular example. But it's good to keep in mind. It also points out to you the importance when you're doing these kind of modelling to be very sensitive to the timing of the cash flows. In some cases, well, in many cases through this course, we're going to assume that the rents are paid in arrears just to keep the mathematics a little bit easier. Keeping in mind, of course, that rents are usually paid in advance and also on a monthly basis. But for the purpose of this course and these examples, we're going to assume annual payments in arrears. Let's move on now. In the study guide, there is this example. I've laid it out in the spreadsheet, and the spreadsheet is available to download off the Moodle site. And the purpose of this example is just really to show you a fairly typical situation. The idea here is that we've got a situation where the face rent, the actual lease rent, has been stuck on $300 per week, and so that's not changing. But for whatever reason, when we start to analyse this situation, we find that the market rents are actually up around the $350 mark at present, and they're going to be increasing to $360, $380 and so on over the next few years, and the property eventually is going to be able to be sold at the end of the fourth year. This is the reversionary interest. What do we have then? Well, we have a lessee's interest of $50 per week. As we come into this analysis, that's rising to $60 and then $80 over the remaining period of the lease. If we capitalise the property at present, we would normally capitalise it on the market rent and not on the face rent. And so capitalising the $350 at 10% should bring us in with the $182,000. However, the landowner isn't really enjoying all of that because there's this interest which is being split with the tenant. In this case, the lessee's interest, the tenant's interest, runs to about $2,600, $3,000, $4,000 per annum as a result of that weekly gap of $50 to $80. By the time you take that as a net present value, it means that the total present value of the lessee's interest is $10,000, almost $11,000. Conversely, by the time we put the landlord's total present value together, we're going to take his term interest, which is the present value of the actual face rents. So it's the present value of 300, 300, 300, 300, discounted for the 4 years, the 4 periods, and then net those together. We also have to add the reversionary interest. So the reversion interest is the present value of the 197,000, and that comes through here with 134,000 PV, and that all rolls up to give you a total interest to the landlord of 201,000. Now that looks pretty neat, and you say, well, that's really good, because here we've got the total value between the two parties as being considerably greater than the present value. And we could probably explain that, because of the simplicity of our example. Really, the fact that there is significant growth in this example, however, we're assuming discount rate and yield both at 10%. Remember from previous studies that really we should have the discount rate approximately equal to yield plus growth. So we do have a little bit of a wrinkle built into our numbers here, but this is only for the demonstration of partial interest. So I hope you'll excuse that anomaly. One other thing I'll just mention at this point is that you can have situations where the sum of the two interests does not equal the value of the property, even if the property is carefully appraised. And the reason for that is often the discount rate will be different between the lessee and the lessor, and those different discount rates, because of their risk situation, will end up sort of tweaking the NPV so they don't quite add up to the present value. That's what's referred to as the marriage value, and you'll find that referred to in the study guide.